Welcome everybody, thanks for joining us today. I'm Simon Glazier, Head of Wholesale Sales here at Fidelity, and joining us today is Lucas DePorbe, our Global Cross-Asset Specialist. And we're here to do a deep dive on bonds, which is a very exciting and interesting asset class. And those that know me know I'm a pretty tragic rugby league fan, and to quote some of the coaches over the years, defence wins games. And just like equities perform in portfolios, it's really important to deliver on client outcomes to have some defensives in there. But one of the challenges in terms of understanding fixed income is that can be quite complicated. There's a lot of terminology there and probably some misunderstanding about the role they play in portfolios. So Lucas, to kick us off, why is that? Why is it confusing? And what are the roles that bonds play in a portfolio?
I think it's sort of interesting because if most investors, equities do take the limelight. Most investors are familiar with equities. They probably have more exposure to equities within their portfolios, and bonds sort of second fiddle. But interestingly, the bond market globally is actually far bigger than the equity market. So the other thing to note is bonds come in a lot more different flavours and shapes and sizes. So the way I sort of describe bonds, it's a full spectrum between your sleep at night type of bonds and your dynamite. But essentially, as you say, they are an important part of an overall investment strategy. They can play that defensive part of a portfolio, and certainly an important building block. But really, if you think about what is a bond, I mean, a bond is really the investor lending money to someone in return for an income stream. And really, there are two broad segments of bonds. There's bonds issued by governments and bonds issued by corporations. And in both instances, they will issue bonds then to fund, be it projects, maybe it's an infrastructure project, or if it's a company issuing bonds that may be looking to expand its operations and so forth. And in return for that, as an investor, you want to be paid an income stream. So in essence, in its most basic form, that is what a bond is. But as I mentioned before, they do come in different shapes and sizes.
Yeah, and we'll dive into that. But you're right, I mean, the bond prices aren't flashing across the news screen every day. And like Australians, we just love our equities, right? Banks and miners primarily. There's a lot of terminology with bonds, fixed versus floating, yield curve, duration, all this kind of stuff.
Yeah.
Can you take us through some of those things and some of the risks that we should be aware of when investing in bonds?
As financial services, we do love our jargon, and there's plenty of it, and bonds are no different.
Yeah.
And there's probably a couple of key things to be aware of. And you mentioned things like yield and credit and so things. So I think a couple of the interesting ones to sort of flesh out a little bit more is one, the yield curve. You may see that being referenced when people are talking about bonds. And what the yield curve is really a representation of the yield offered by bonds at different maturities. So what I mean by that is, for example, a bond, a one-year bond, so a bond issued for a one-year period, will have a certain level of yield attached to it. A bond issued for a 5-year period is a certain level of yield, and a bond issued, say, for a 10-year period is a certain level of yield. And generally, in a normal environment, what you would expect is that the longer term bond, say a 10-year bond, should deliver you a higher income than a shorter term bond. And that is effectively because you are lending money for a longer period of time. However, that's not always the case, and the yield, the shape of that yield curve, so to speak, can vary over time. And that's an important sort of consideration when thinking about bonds, because that can have an impact on the price of a bond, on the returns of bonds and so forth. The other probably key one to flesh out is credit, and what does that mean, and credit risk in particular. So this more relates to if you're investing in a corporate bond. So if a company's issuing a bond, again, like a government bond, you expect a certain level of yield. Usually that will be a spread above a risk-free rate. So the risk-free rate is, I guess, typically something like a 10-year bond. And so what is the margin you are getting above that risk-free rate? And that's what the corporate bond issuers will look to pay. And that spread can indicate a couple of things. So one is the risk of the issuer. So again, if you are lending money,
we talk about AAA, triple B.
Correct, absolutely.
Risk assigned to that.
Exactly. So if I'm lending you, $10, and you're a good credit.
A good credit.
You got a good credit score.
Yeah.
You're going to pay me back. I'm probably going to charge you. You're probably going to get a lower level of income or interest for that type of investment compared to maybe lending to a corporate that's a bit more riskier.
Gotcha.
And so you expect a bit more margin for doing that.
So, we've talked about two things there. So the yield curve, which we say moves, can move over time. And then the credit risk on the corporates that are issuing bonds. So I think about active management then, and active and passive, which, there's a lot of both out there, right? What are some of the benefits of active management when it comes to managing and investing in bonds?
Yeah, absolutely. So if you think about even those two metrics, whether it's the yield curve or credit spreads and so forth, they're not static. They do move around. They move around based on what the expectation of economic growth is. So for example, if the view is that we're maybe heading into an economic slowdown, generally what you tend to see is the yield curve may flatten or actually invert, whereby the longer term bonds, your 10-year bond is actually paying less than the shorter term bond. Conversely, on credit, if you see the outlook for economic outlook maybe diminishing, you may see credit spreads widen. And so as an active manager, typically what active managers will do is they'll do a lot of analysis, for example, of the macroeconomic environment. Are we maybe heading towards a slowdown or are we heading into a growth environment? And they can move around their portfolio in accordance with that view. So they can take on, for example, more interest rate risk, less interest rate risk, more credit risk, less credit risk. And the ability to navigate that environment, particularly if it's a more volatile environment or one where we are experiencing some changes, the fund managers can actually add value against the benchmark by employing these active strategies. Whereas a passive investment, as the name suggests, you effectively will track the benchmark. So there's horses for courses. It's just understanding the risks. Probably one good example is if you think about a passive strategy. If you invest in a passive bond fund, that maybe a government bond fund or a fund benchmark against the global aggregate index, for example, that will have a certain amount of what you call duration risk or interest rate risk. So how sensitive are you to interest rate movements?
So the higher the duration, the more sensitive.
Correct. Whereas an active manager is also exposed to duration risk, for example, but they can actually move that up or down and take on more or less duration risk depending on their view on the market. So it's just really what you're getting with an active manager is a lot more flexibility and ability to navigate the market in order to either enhance the yield or to generate a capital return.
So the macro piece for fixed income, particularly when it comes to duration, is important.
Absolutely.
But then the credit assessment of the credit issuer, of a corporate,
Yeah.
is also important when you're on the corporate
Yeah,
side.
absolutely. So if you think about the corporate side, it is then really about that, from an active perspective, that bottom-up research of the corporate, of the balance sheet, and so forth. And the reason that's important, because as you mentioned before, there are credit ratings that issue credit ratings on corporates. What an active manager can actually do, they may sort of take a view that actually this corporate may be rated lower, sort of investment grade or below, maybe. However, based on the research that the fund manager has done, believe actually that they may be upgraded to a higher credit rating.
You could be getting a better reward for the
Correct.
perceived risk that you're taking.
Exactly. Right, So these are the sort of the nuances an active manager will try to determine and identify and add value through that active approach.
Yeah, it definitely seems like there's a lot more going on, both on the corporate side in terms of risk, but also on the macro side in terms of duration. We've seen interest rates move a lot more than what we have in the previous period, that's for sure. So why do we still use bonds in the portfolio today? What is fixed income there to do?
So bonds, if you sort of strip it back at the top level, they play two roles. One is to act as a diversifier to your risk assets, such as equities. and the other one to generate income. Now those things, there's a bit of a trade-off between both of those things because some bonds are more focused on income generating, other bonds will be more focused or more play a diversification role within a portfolio. But fundamentally,
you can't just have one then.
Correct.
Okay, right,
correct.
Right.
You need to sort of understand, what type of bonds are in the portfolio, what each type of bond plays, and in what part of the cycle would you expect each bond to play. But ultimately, first and foremost, as a portfolio constructor, you're looking to bonds to play that diversification role first and foremost.
So what things should we consider then when we're trying to build out that allocation, that bond fixed income portfolio?
Yeah, so really, if you were to break it down, there's probably three key things to think about. So one is how much sensitivity in your portfolio do you want to interest rate risk, so duration risk. And so, and that will be based on one, maybe what your view on the market is, but really duration is that part of duration risk is that part of the fixed income spectrum that is really intended to give you that diversification away from equities. So it's not always going to be the highest yielding, but it tends to be
a bit more of a buffer.
A bit more of a buffer in normal environments. So when equities sell off, generally, those type of bonds will do better. So that's duration. The other component of your portfolio that you want to consider is then, well, what exposure do I want, for example, to credit? Because credit, on the other hand, is more of an income play. Credit tends to be a bit more related to equities in terms of the performance, so a bit more correlated, but does tend to generate more income. So as you can see, there's a bit of a trade-off between how much diversification you want to equities and then how much income you generate. And then the final thing to consider are, active strategies that maybe are more what we'd call alternative strategies that behave a little bit differently to your conventional traditional bonds, and it's an additional diversification layer. And I think at a minimum, for anyone that's invested in bonds, is just being really aware what you are exposed to, because it is one, with equities, it's a bit more sort of intuitive, equities go up or down, whereas bonds can do that as well. And for example, if you've got too much exposure to one type of bond, maybe it's credit as an example, in certain market environments, you can actually obviously lose money as you can with duration. So it's really understanding what risks, how much risk you want to take, and what the role is.
Because I'm just thinking about basically a bond. If you hold it to maturity, you get your money back plus the coupons you've received over that time. But in a fund or a professionally managed portfolio, there's still buying and selling.
Absolutely, because you're still actively managing that portfolio, and as I mentioned before, you are also looking to add value. Because again, if buying and hold, that's sort of, you're right, but the market does change. So you might see the yields change in the market. The macro environment may change. So for example, you might get an inflation coming in, you might get an economic slowdown. All of this provides an opportunity for active managers to add value by exploiting these sort of inefficiencies in the market.
Both on the income, the diversification and capital protection side.
Yeah, absolutely.
Perfect, Lucas. Thank you very much.
Thanks a lot.